Hey y'all, and welcome back to Getting Digital with Deja. So this week's topic, you guys, is about futures trading. If you want to learn about trading futures, this is the video for you because I realized that I've talked about crypto, I've talked about forex, and I've talked about options and stocks, but I haven't really talked deeply about futures trading here on my platform, and it's really crazy because I literally started off with trading futures. So, in my personal opinion, I do believe that futures is one of the easiest markets to understand and to grasp. But there's so much information that you need to know to make it easy for you to trade. So, I'm going to be giving you the information bit by bit. So, today's video is just going to be an introduction to futures. So, if you're not really sure what futures trading is, or what's being traded, or the value of the movements and things like that in futures, or the classifications, the names, all that kind of stuff, this video is most definitely for you. But today we're just gonna dig a little deep into futures, and then Wednesday I'm gonna teach you how to trade futures. So one thing at a time, so I don't boggle your brain with too much information. So first, let's talk about what a futures contract is, so you can better understand futures trading. And I love my textbook definition, so I brought out the notes for you guys. So futures are classified as derivatives, a contract that derives its value from the performance of an underlying entity or commodity. It is the role of the futures market to draw on all known information about next year's commodity or crop and figure out what the forward or future price is. So that's where futures gets its name, if you understand the relation. So the amazing thing about futures is that there are so many different markets that you can get into, that you can trade, that you can educate yourself on and become an expert at. So one of the main markets is metals, which are like gold and silver. Then you have energy products like crude oil. WTI crude oil is like one of the biggest things traded for futures. There's a lot of money in that market. Then you also have natural gas. You have soft commodities like coffee and sugar. You have grains like corn, rice, soybeans. And the really cool thing about corn is one contract of corn is 500 bushels. So it's like, with options, one contract is like 100 shares. Well, imagine one contract being 500 shares if you're in futures. I mean, I know it's not the same, but you see the correlation. The really cool thing about futures is that it also deals with the stock market as well, because you can trade the S&P 500 but on a smaller scale, which is called the E-mini S&P 500, which is basically allowing traders to get exposure and things to the stock market, the S&P 500, without really risking as much as you would regularly trading the S&P 500. So it's really, really cool. And they also have this thing called equity indices, which is basically tracking the value and the changes and fluctuations of stocks, a group of stocks over time, and that's measured on a national and a global level. So as you can see, futures market is so broad. You can trade things like corn all the way to crude oil. You can trade strawberries. You can trade soybeans. You can trade coconuts. Like any commodity that you can think of, a commodity or crop that you can think of, is a part of the futures market. And to better understand the futures market, if you're still having a little bit of trouble, it's just basically anything that's like a commodity, a crop, or product that needs to be traded, bought, and sold literally is part of the futures market. So we buy fruits, we buy vegetables, we buy oil, we buy gas, we buy coal, all the things that we need basically to survive or for our health and things like that is part of the futures market. And time for a fun fact. My first big girl job was actually at a news reporting station where I wrote digital news, and I tracked the prices, the future prices of wax, paraffin wax. So that's literally a market. Paraffin wax is used for candles and things like that. And I was literally tracking the prices and setting the prices for wax futures. I was doing all this without even knowing anything about trading, like at all. So let's get into the pricing for futures. You have two things. You have something called contango and backwardation. So contango basically means that the forward prices are being priced higher than the current market price of whatever that commodity, crop, or product is. Backwardation is a complete opposite. It's when forward prices fall below the current market price of that product or commodity. And then on top of that, it could be for a short-term period or for a longer sustained period of time. So the easiest way to remember this is contango is up and backwardation is down. And backwardation, is really easy to remember the definition for this, because just think of the prices going backwards. So it's going down. It's like not going forward, which means it's not gaining more value. It's losing value. It's going back in value. You know what I mean? I feel like that was great metaphor. Now it's time to get into the fun part on where the money comes in. And basically, you can track your profits or your losses through tick values and tick sizes. So with futures contracts, the commodity basically specifies what tick size and what tick value is going to be associated with that crop or with that contract. So a tick size is the smallest price increment that a commodity or a futures contract can move. And tick value is a dollar amount that you lose or that you profit for each tick move. So in this video, all my examples will be related to WTI crude because that is like one of the most top traded things in the futures market, and it's like a really easy way for you to understand the futures market. But a tick size in WTI crude for a regular size contract is 1 cent. Now the dollar value, the tick value for that is $10. So for every 1 tick, you're getting $10 profit or loss. Now you're probably like, okay, so how do you go from 1 cent tick size to a $10 tick value? Like, how does that make sense? Well, this is how it makes sense. So one contract for WTI crude oil equals 1,000 barrels. So you're going to take that 1 cent and you're going to times it by 1,000. If you have just one contract, you're going to times it by 1,000. So each tick move will be $10 because 1 cent times 1,000 is $10. Now it's super important to remember this, that each commodity that you trade could be completely different from the next. So, with corn, one contract equals 500 Brussels, right? So the tick size would be times 500 and that would give you your tick value, okay? But with WTI crude, it's 1 cent times the 1,000 barrels of crude, which will give you $10 tick move or $10 tick value. So the great thing about futures contracts is that you don't necessarily have to memorize or Google or just guess what the tick size and the tick value is going to be, because all those specifications will be listed on your contract that you're about to trade, and that's going to be on your platform through your brokerage. So all that is public information. Is going to be like literally in your face for you to see, so you can calculate how much you anticipate to win or how much you anticipate to lose. So that's good for risk management and things like that, because you know exactly how much it's going to move. Similar to pip movements in Forex, very similar to pip movements in Forex, but the values are quite different. So in my previous video, when I was talking about trading small accounts, I mentioned micro futures contracts, and the tick value for that is going to be a lot different and a lot smaller from the regular size of a futures contract. So it's going to be 1/10 the size of a regular size futures contract. So instead of being 1,000 barrels, it's going to be 100 barrels. So instead of you timesing that tick size by 1,000, you're going to be timesing it by 100 instead. So the profit is going to be much less, but there still is a lot of money to be made in the futures markets, whether you're starting off with trading micro futures or you're just going to jump in and do a full futures contract size. And now the last thing we'll be talking about today for our introduction to futures trading is the specifications and the names of the futures contract. So for futures contracts, they do have specifications in what they call futures codes. So it's not going to be the exact name of the commodity you're trading with the month and the year and everything. No, they put it into a code. So the first 2 to 3 letters of that contract is going to be whatever the symbol for the commodity you're trading is. So for crude oil, the symbol for crude oil is CL. The second part of the name of that contract after the CL is going to be 1 letter, and that 1 letter is going to represent whichever month it expires in. So this is when it gets a little confusing and weird, because the letter of the month doesn't correspond with the letter of the month, if you get what I'm saying. So like January, the letter for that in futures is F. And then February is G, March is H, April is J, May is K, June is M, July is N, August is Q, September is U, October is V, November is X, and December is Z. Why is December Z when it starts with a D? It's like, why are you trying to confuse me? And after you have the first 2 to 3 letters of whatever commodity you're trading, followed by the 1 letter of the expiration of the month for that contract, you're going to have 1 number that represents whatever year that contract is expiring. So in 2025, you would have a 5 at the end of it because that represents 2025. So, for example, a crude oil contract that expires December of 2025 would be CLZ and then 5. And then a contract that expires in January of 2027 would be CLF7. Super, super weird. And another weird part about this is on different platforms, the letters can change. The structure of the contract name can also change. So it's just like, why are you trying to confuse me? So I know some of you are probably wondering, I did start off the video saying that I did used to trade futures. That's when I first started trading. And I stopped trading futures. And I didn't stop trading futures because it was unprofitable or anything like that. I just really prefer trading in the options market because it has so much to do with politics. Now, don't get me wrong, futures has a lot to do with politics, but I like literally researching news and seeing what it's going to do to the environment, see what it's going to do to economics, microeconomics, what it's going to do to stocks, what it's going to do to businesses and things like that. That's something I really, really enjoy. And yes, you can do that with futures as well, but it's not as like imperative. So news is very important for the futures market, especially if there's a war or something. The prices of oil are going to change dramatically. But I don't know. I just think there's a lot more drama in the options market, and like, I'm here for it. But that is all that I have today for your intro to the futures markets trading. And on Wednesday, I will be coming back with talking about expiration dates, rolling over positions, opening positions, and then also with examples of different futures like scenarios and contracts and things like that so you can better understand it. And then on Friday, we're going to go into how to trade futures. But I feel like you need to know every single step in order to understand how to trade futures, because the more knowledge, the better. The more you know, the more you grow. I believe in that wholeheartedly. So instead of trying to just rush, take a week with me to just learn it first. Literally just a week. That's all I'm asking of you. And then start. But really, don't start. Start on a demo account. But each is its own. But okay, you guys, always remember that pretty girls can do futures trading too. All right, I will see you guys on Wednesday for part 2 to futures.